Bigger than expected inflation number. Market's down pretty drastically. I actually read a statistic today, Carl, that this is the second worst start to a year, the first 9 months since 1937. So the S&P 500 is down roughly 25% for the year. The NASDAQ's down roughly 32, 33%. But what we've been telling clients, and one of the most trickiest parts to not only what we do, but around the globe has been the volatility in the bond market. So the Barclays Bond Aggregate Index is down 16%. But let's kind of get into the CPI first. So inflation numbers came out 8.2%, big drop from 8.3% from the month prior. And what a lot of people don't realize is that, yes, it may have peaked at 9.1, but we were in the eights back in March. So, essentially over the last 7 months, we haven't really seen any meaningful change in inflation despite this aggressive policy move from the Fed. I'm going to pull up some things on the internal statistics of CPI, but, do you have any, big overview of your view of today's reports other than the crazy turnaround that we saw in stocks?
Yes. I mean, inflation's been stubbornly sticky,
right?
And it's been a little bit confusing, but I think what it really amounts to is that you really need to get interest rates up, and the economy needs to slow down, and there are a lot of things going on that are making it a little difficult to understand that and predict all of that. And also how the Fed is reacting has been a little bit politicized too. So that's making it trickier. It's clear that it would have been better if they had gone faster, but it seems like what they're doing now it's probably okay. It would have been better to have done more sooner, but we'll just have to see how it goes, because right now everyone discusses like how long will it take for the rate hikes and the quantitative tightening that's being done to have an effect. And a lot of people seem to think that it could be 6 months to a year. And all the rate hikes have really been done, but most of it has all really been done since June.
The last 3 months.
So that's not really enough time to really see the effects. So I think if they're really serious about getting inflation back down, there's a big risk that they'll overdo it.
Yeah, well, they have a pretty good track record of not getting policy exactly right. And it's easy for us to, or anybody else, to really criticize the people that are making the decisions or how much or how little to do. But what people need to understand is that it's extremely tough. It's a tough job. And, very rarely are you, or do they build a monument, or are you looked at like a Paul Volcker? But I'm sure in the early 1980s, I'm sure there was a lot of people that were sending hate mail to Paul Volcker during that period of time.
Yeah, but unfortunately, it is political, and politicians' first job is keeping their job.
Yeah. So it was a lot hotter than expected, 8.2% down from 8.3. I woke up this morning and before I started to work out, and the market was down pretty big. And by the time I got into work, the market had basically reversed. It was also one of the biggest single day reversals since March of 2020 during that chaotic time during COVID. And what I'd like to point out about these things that we're seeing, and we'll get into the bond market in just a few minutes, but these moves that we're seeing, to me at least, talk about how fragile the system potentially is, and maybe even potentially liquidity problems. I mean, we shouldn't be seeing, the 600 basis point moves in equity prices. I mean, it just doesn't seem normal to me, and I may be wrong in that, but what are your thoughts on just these crazy moves just in general?
Well, when you get into a deep correction or you're going into a recession and it's clear to a lot of people, things get like that. I think the more surprising thing is that we're having movements like that, and the volatility index is not really up.
Yeah.
It
It's like it's on
should
spring
be.
break. It forgot about everything.
it probably should be higher.
Yeah.
So it's a little bit strange. I mean, I think the reaction early this morning was the right one. It's a little bit perplexing why things turned around and went positive.
Right.
It seems like there are a lot of people who were positioning for a higher inflation number than expected,
Yeah.
and then maybe they wanted to close whatever positions they had really quickly, and that caused an abrupt reversal.
Yeah.
But it's just strange because the fact that or a lot of people are trying to catch a bottom, or there's still this fear of missing out going on, and the volatility index is not really that high, tells you that there isn't really that much pessimism out there yet, and everything that's going on is probably going to continue to go on. We'll see what happens here. It might just be like last week where there were a couple strong up days, but
It was
nothing
wiped
had
out.
changed. And then by the end of the week, everything rolled back over. So we'll see. I mean, it might be that, we're back down in another week.
Yeah. So, according to BLS, the CPI print that just came out, I just wanted to share a few of the annual inflation year-over-year changes. Some of these are pretty extraordinary. Some of them obviously have been hit from COVID and then coming out and the pickup of demand, all those kinds of things. That's particular to the airline fares. Airline fares up 43%. This is something that affects everybody, whether you rent or own a home. Utility gas is up 33%. That's an astronomical number.
Right. We know why that is. That's because gas prices are up because Europe needs more liquefied natural gas.
Yep. So it increases the demand on our side, which we end up paying the consequence for that.
Why would eggs be up so much? That seems weird.
It's probably something to do with laying a few less eggs. I don't know. That one was crazy. Gasoline up 18%, even though
Yeah, that's understandable.
yeah, even though it's up, it feels like it's up 100% to some people. But chicken, coffee, milk, bread. I mean, the
Why are
necessity,
those things up so much?
the necessities for living. I mean, you're seeing these huge price increases, and I think the core CPI was still up 6.6%, which excludes energy or shelter or food and energy. And it was still up 6.6. So even if you look at the core CPI, 6.6 is still astronomically high compared to where the federal funds rate is. And used cars only up 7.2. So you're starting to see some of these declines. And that's what a lot of people have been talking about, Carl, is you're starting to see the rollover and obviously shipping costs. You're seeing some rollover in the commodity prices of things like lumber. And they're pointing to those things that saying, maybe inflation will drastically decelerate all of a sudden once the economy absorbs these higher rates. But the reason why, you haven't seen lumber prices go down or other things go down within the stores is because there's a middleman between everything, right? You've got the producers of a product, and then you have the manufacturers of that product, and then inevitably the end consumer. And unless that manufacturer or middleman, adjusts their price on a collective basis, you're going to still maintain these higher prices for a pretty significant amount of time. And what it all starts with is that input cost, right? I mean, I think the PPI, the producer price index, also came in really hot. I think it was 8.7 or something like that, or 6.7 maybe. But I mean, it's just, we're not getting any reprieve. But to your point, it's only really been 3 months since we've seen these accelerated rates. And even though the market's down 25 to 33%, it has been relatively orderly so far this year.
Yeah, I mean, what stands out to me about this is that most of the time in the past, like people haven't really been talking about recessions that much, or when you've seen the traditional signals for them, they find reasons to doubt them. But
Yeah.
now there's so many people that are feeling pretty confident that that's going to happen. So you get all this volatility because markets are trying to anticipate everything, and then everybody is trying to front run everybody else, get out before everybody else gets out, but then also get back in before everybody else gets in. So
Yeah.
it's creating, it's creating a lot of volatility, but what's interesting about it is that it's not driving the VIX up.
Right. Yeah. And I think you and I talked about this earlier this week. I mean, you ask 10 investment managers and probably 9 or 9.5, if you can consider a half, 9 to 9.5 of them will tell you that we're going to be in a recession, within the next 12 months. And we were talking earlier that this may be one of the first times in modern history where you've actually have this huge flock of individuals that are basically forecasting and telling you that there's a recession prior to the recession actually beginning. I mean, they've done this for, basically the last 6 months. And I think that's really interesting.
Mm-hmm.
So, all right, next up on our list has been this crazy bond market. I wanted to pull up a chart of LQD just because it's pretty interesting. So LQD, Carl, that is the investment grade corporate bond market. So it's an ETF. So it only
Right.
corporate bonds that are investment grade. And you can see if you would have invested in this just on a price basis, not dividends, but just on a price basis, if you would have invested in 2003 when it came out, you can see that drastic drop on the right-hand side so far over the last, 11 or 12 months. You wouldn't have made a nickel on the price of this ETF, but basically it's trading back down to where it was in 2008, 2009. And I think that, in my opinion, this should be a worrisome sign because we do know how much smarter the bond market is than the equity market.
Well, a key thing there is how much of that price decline is just due to rates going up versus how much is spread widening against treasuries. So I'm actually on BlackRock's iShares website right now looking at this.
Mm-hmm.
So it actually has earned almost 4.2% since inception because there's been a nice
Dividend.
yield on it. But yeah, it's been a little bit negative the last 5 years, but that's because, all through that period from like 2014 through 2020, interest rates, on treasuries and the ag were like 1 to 2%.
Right.
So now suddenly things are at 4, and the yield on this is probably a little bit higher because it's investment grade bonds.
What's the duration on this portfolio, Carl?
Yeah, let's look at that here.
So duration is the average length of time that the bond has until maturity.
Yeah, well, sometimes when people say duration, they mean the length of time to maturity. Other times they mean like the interest rate sensitivity of the portfolio, which is a mathematical cash flow based calculation to tell you, how much is the portfolio going to go up or down for 100 basis point change in rates. So just trying to see where do they have statistics on all of this stuff.
And while you look,
So they do. So the way, so what they call it here is maturity. So the weighted average maturity of the portfolio is 13 years.
okay.
So they've got bonds in there. So this is kind of a longer term portfolio, that the ag is around 8 years.
Yeah.
So the effective duration here is 8.2. So for 100 basis point change in interest rates, this portfolio is going to go up or down 8.2%.
And if you've seen a 200 basis point movement, that'd be 16. And what's it down year to date so far?
And year to date, it's down 21.
Yeah. Okay.
So yeah, year to date, I guess something around a little more than a 10-year treasury is like a good proxy for this thing. And so like if we look and see like how much has the 10-year treasury yield gone up year to date. It started the year at 1.6 and now it's at about 4. So that's 2.4%.
Yeah. That's
Call
where you
it.
get the 2021.
So or 240 basis points, you know.
It's equivalent to 21% drop.
So yeah, so if you multiply 8.2 by 2.4, that's going to be like, maybe,
That's 19.7.
yeah,
Yeah, almost there. Yeah.
and you
So I
need a
mean,
calculator to
but the
do that
point,
to do that quickly. So yeah, you're almost there. So like, like 90% or more of the decline here is just due to the fact that rates are up. And that's usually the way it is for investment grade bonds
yeah,
because, the credit quality is really high. Like you're probably not going to have defaults. Like this portfolio is, yeah, it's corporate bonds, but like, do they say like average credit quality here? I mean, it's probably, investment grade means like everything from triple B up through triple A. So
right.
there's like a lot of, you look at the stuff that's in here, it's all like the big banks and like AT&T and Verizon and
Yeah.
Apple and Comcast. Like these companies aren't going bankrupt,
Right. But
even if the economy gets really bad. So like this is a really safe portfolio, but yeah, they're probably, the extra like 1.5% or so to get to the 21. There's probably, because we've had stress and we're in a deep correction bear market now. There's probably been a touch of spread widening in investment grade, and we could probably go over to Y charts and look at exactly what that is on a certain index. I know there's been spread widening in high yield. We
yeah.
kind of watch that a little bit.
But to your point, it's been a tremendously volatile year within the bond market, one that you and I haven't seen in our lifetimes. And it's kind of crazy. When we meet with potentially new clients, and they're looking at their 60/40 portfolio, and that's down 20 something percent for the year. It's interesting, but it's all due to this rapidly changing interest rate environment,
Yeah,
because of
bonds
how
haven't been a
bonds
help in a rapidly rising rate environment.
Yeah. Now, speaking of rapidly increasing interest rates, we can't not have this show and talk about the Bank of England. So, we want to give the down low on kind of what happened over there in England over the last week.
Sure. So actually, I think it was a couple weeks ago now. Um, what happened was the bond yields, their longer term bond yields started going up really quickly, and it was due to some problems in the pension funds. Apparently, they use a lot of long term bonds and they use some leverage. Some of them are using derivatives to get exposure to that. And it's something that like pension funds can do because like part of how they think about things is asset liability matching. So if they have liabilities going out 20 to 30 years, you might have some bonds to, that mature at those times to cover those liabilities.
Yeah.
Makes sense, right? But when you use leverage in a portfolio and you have something in your portfolio or a lot of something in your portfolio and it goes down in value really quickly, like now you have a problem. And if it goes down in value enough, you can get margin calls and, people tell you that you have to sell. So this was starting to create a problem where yields were, I think the long-term gilt yields went from like 3.5 to like 5 in a matter of a few weeks.
Yeah.
And so the Bank of England stepped in and like pension funds were having big losses and having to
Post
force them to
collateral.
sell their longer term gilts. And so they called the Bank of England and said, like, we need help. We can't deal
Yeah.
with this. And it sounded like it was a lot of them doing that. So
Yeah.
they acted and they started basically, even though they've got 10% inflation over there, they started to do the equivalent of QE,
Quantitative.
quantitative easing, and buy long-term bonds to push the yields down. But the problem with what they decided to do was it was just a fixed amount and they were only going to do it for a month. So like in another week, they're going to stop.
Right.
And at that point, things might go haywire again.
Yeah, I wouldn't be surprised. So just for everybody that doesn't know, a gilt over there in the UK is equivalent to like our 10-year treasury here. And essentially what happened in a nutshell, to Carl's point, was, these pension funds have to send out distributions for people's lives. And if you know anything about the average pension fund just across the world, they're underfunded, right? People are living longer. We've talked about this before. And what these investment managers and institutions did is they came up with these derivative products that allowed them to basically use leverage to get a higher than average yield on these bonds, so that they could help stretch out the pension fund's viability, and continue to produce, a high rate of income for, an extended period of time. Well, when you do that, you're basically doing that on margin, right? Where you're basically borrowing money to purchase those things. And when, like what Carl said, when interest rates moved up rapidly in that short period of time, it forced these pension funds or these asset managers that were working on behalf of these pension funds to post collateral. Well, when you post collateral, you're basically forced to sell other assets in order to post that collateral. And they were running into significant liquidity problems. So just like you said, what the Bank of England had to do, and it all came off the backs of them announcing a huge tax cut, which seems really idiotic in the time of facing 10% inflation. It's almost like sending inflation stimulus checks out to people, thinking that's going to solve inflation. But once that was announced,
Right.
it was
Well,
shot.
yeah, that's something that contributed to
And what I learned
it, because
was,
the world, based on their government's financial situation, world didn't think they could really afford that.
yeah.
And so the pound was weakening.
And what I learned was that proposal had already been approved. It had been sitting on the Queen's desk already, and she was going to announce it, a little bit later than everybody, knows what happened to the Queen. So then they announced it after her death, and it was just really, really poor timing. So what the Bank of England had to do was basically be the lender of last resort to this pool of collateral, and tell everybody that we'll buy, the bonds, because if Carl's forced to sell and I know Carl's forced to sell, then I'm going to get the best price for me, not the best price for Carl. And then when the next person needs to sell, that's why, forced liquidity causes, a waterfall type of reaction within prices. And that's exactly what happened in the Bank of England. But there's some serious cracks, right? You've got a huge amount of debt, not just here in the United States. Everyone likes to talk about the US, but the global economy. And you've got really weak economies, specifically in the Eurozone area, and Japan is another country that's suffering as well. And inevitably, what this is going to lead to is currency problems. So I think that's something that people need to watch out for. I don't know the details if our local pension funds here in the United States use similar things. But that could be a systemic risk that affects the overall marketplace, if it is actually a systemic risk that's going on right now.
Right. Yeah. I mean, that's what a lot of people have said, that, this could all lead to currency problems, but the dollar keeps strengthening this year because
Gosh.
the the Federal Reserve is raising our short-term interest rate faster than other developed country central banks are, and they're in worse shape than we are with regard to inflation and being in Europe, with their energy undersupply caused by the war there. So yeah, how currencies trade is all a relative thing based on where global real interest rates are, and
this is just
global economic growth.
Yeah, and before we get into the last
countries.
topic, I mean, everything that we've said just kind of speaks to the positioning that we've put ourselves in and our clients in, for the last 3 or 4 months, of let the economy figure out how it's going to work through these problems. Let the market figure out how it's going to adjust to the higher rates in the economy. Take a much more conservative position. Let things kind of figure themselves out. because at this point, short-term treasuries seem like the best risk-adjusted rates of return at this standpoint, based off of everything that's kind of going on. But yeah, so that's just something from a tidbit of what we're doing. But we've got earnings. It officially kicked off today, right? I think BlackRock came out, Domino's came out, the banks come out starting tomorrow. What are your thoughts on the overall earnings season? Last time we had earnings, they were better than anticipated. That caused a short-term rally in the market. Obviously, bond yields came in a little bit, but what are you looking for this quarter's earnings?
Well, I think something similar could happen this time because things have been pretty oversold.
Yeah.
But we still have a lot of headwinds. So the
And
dollar,
no Fed pivot, right? No Fed pivot.
right? I mean,
built into the
that's the main thing in the background, is that inflation is still going, and the Fed keeps raising rates. So for companies that aren't growing and have a lot of debt, they probably, unless something has changed and they're able to get pricing power and generate revenue in excess of their cost increases, companies like AT&T and Verizon, they
right.
probably will continue to not have real good quarters. Anything that is
Real estate.
yeah, I mean, real estate could be troubled too, depending on how the balance sheet looks
Yeah.
and where all the debt is. But yeah, that's a big reason why REITs have probably underperformed this year, is that they haven't, if the economy is not real strong or weakening, they may not have, the ability to raise rents as much at their properties, or there may be vacancies starting to develop depending on, which sub-industry they're in over there.
Yeah.
And then, the financing is going to get more expensive depending on how it's laddered out, because this period of higher interest rates, it's not going to there isn't going to be, like, it's becoming clearer that there's not going to be a Fed pivot real soon. Like, we're going to have higher rates for a while. The big questions are, like, how high are they going to go, and how long are they going to stay there?
Yeah.
So that is going to affect the balance sheets of companies that are highly indebted, yeah, and their income statements, and their, affect their earnings to the extent their interest expense ends up going up more. But I think most companies are more immediately affected by operating expenses going up. Like if they don't have a lot of efficiency in their labor force, or they have to go out and like hire people and pay them a lot more,
Yeah.
or they've just got other expenses like energy and other things that are up a lot.
Yeah. So I mean, there can be a short-term bounce based off of, earnings not being as bad as what people expect them to be.
I think dollar strength is going to be a big thing that's going to affect the current quarter and guidance a little bit more. That's what we heard in the second quarter, that most companies, they either met expectations or they narrowly missed, and it wasn't as bad as people expected, but it was because of some global disruption, mainly in Europe, mainly due to the war, but also because of dollar strengthening. And then
well, it's gone up.
Guidance was a little worse.
Well, it's gone up 10% since then, just since the second quarter, right? So I don't know if Microsoft, Google, all of these companies that have significant overseas exposures were really predicting another 10% increase in the US dollar quarter over quarter.
Yeah,
so you're
usually, right. I mean, often companies miss or beat expectations for something like a currency change, because a lot of analysts tend to not put those kinds of things, those big macro things, into their estimates. Normally, they're very good at forecasting volume of products. You can do channel checks and talk to a lot of people, knowing the pricing on things and how the pricing is moving. Like, the companies communicate that stuff really well, so they're usually pretty good at those things. But I mean, the things that move stocks more are the things that create surprises.
right.
And so that's a key one. And Well, we'll see. I mean, it's a little bit hard to know with earnings how stocks are going to react because you can have an understanding of all of this going in, but if the price is down a lot or maybe more than it should be, and these things are relatively small compared to the recent share price move, then shares can actually bounce even though you have misses
Yeah.
or things aren't so good. And that happened a little bit in the second quarter, but I think a lot of it was also because somehow people started to get worried about a recession and bond yields started to come down. But that hasn't been the case now. I mean, they're at new highs and the market is really at about this after today, it's at the same level that it was back in June. So I would say that we're kind of in neutral territory.
Yeah.
And given the dollar strength and the other things going on, I think it's a little bit of a toss up. I don't think it's as clear that we're actually going to have a strong few month rally.
Yeah,
after
I
this.
think you're exactly right. And, don't fight the Fed. Don't fight the Fed on the way up. Don't fight the Fed on the way down. And the Fed has been very clear the last two announcements that they are going to be persistently keeping rates higher for longer. So it'll be interesting to see earnings. I think, maybe you get a little short-term bounce, but inevitably nothing fundamentally has changed with the economy. The sad thing is in my opinion, the only way you deal with this high inflation other than time, right? Because as more time goes on, year-over-year changes should probably slow down. But even this month, it was up 0.6, right? So multiply that out by 12, you're at 7.2, right? So, I mean, that's still significantly high. So the only way that you're going to get this inflation under control, unfortunately, is put people out of work, make them miss their rent payments, make them miss their mortgage payments, suck that liquidity out of the consumer's pocketbook. And it's nothing that I would ever want, but unfortunately, I think it's what's necessary to get this inflation under control. And it's the consequences of poor mismanagement of Fed policy for, an 18-month period of time.
Yeah, and that's also probably why going forward, maybe we'll start to see it a little bit in this earnings season, but in subsequent ones too, we'll start to see more bifurcation in results of companies. So like Domino's Pizza had a good quarter today. Pizza, it's cheap food. Costco is doing great. Walmart is probably going to start doing better. And the things that are more discretionary, cyclical, luxury goods, that kind of stuff is probably going to start not doing as well.
Amen. That was a perfect note to end it on, sir. Well, thank you for your time. I took a little bit too much of your time today, but I hope everybody enjoyed it. Anything else you'd like to add, Carl?
That's it. We're good. I mean, we haven't spoken in a while, so we put a little more into this one.
We do want to let everybody know, keep an eye out. We've got our third quarter commentary coming hot off the press from Carl pretty soon. So make sure you read that and let us know if you have any questions. Just reach out to us. Thanks, Carl.
You're welcome.
All opinions expressed by Andrew Whalen, employees at Whalen Financial, or any other podcast guest are solely their own opinions and do not reflect the opinion of Whalen Financial. Whalen Financial is a registered investment advisor. This podcast is for information purposes only and should not be relied upon for investment decisions. Clients of Whalen Financial may maintain positions in the securities discussed in this podcast.